Good morning, good afternoon, good evening, wherever you are in the world. I'm Nicolas Véron. It's my pleasure to introduce this first session after the summer recess of the financial statement series at the Peterson Institute for International Economics. Today, we will talk about an age-old curse or issue, the bank sovereign nexus, which can become a vicious circle with a particular emphasis on developing and emerging economies. And we couldn't think of better speakers for that than Pablo Saavedra and Ceyla Pazarbasioglu. Pablo Saavedra studied economics in Bolivia, then a PhD at Georgia Tech in Georgia. He has worked at the World Bank ever since, has worked on numerous geographies and countries, on Poland, Ukraine, Belarus, Latin America, and the Caribbean as a region. He was also the country director for Mexico. He has worked a lot on fiscal policies, of course, germane to our topic today. He was then, for some time, the chief of staff to the president of the World Bank. And in 2022, he was appointed the vice president of the World Bank for equitable growth, finance, and institutions, known in the World Bank acronym jargon as EFI, which is now also known as Vice Presidency for the Prosperity Verticals. That includes economic policy, poverty, finance, institutions, competition, and investment. So I'm not sure what is left for other vice presidents at the World Bank, but we'll have a lot to cover today. Ceyla Pazarbasioglu studied economics at let me see if I can get it right, Boğaziçi University in Istanbul, and a PhD at Georgetown University. She has also been a visiting scholar at Princeton University. She has worked at the IMF in the 90s on transition economies, and in the late 90s, in 98, she became the chief economist of emerging European markets for ABN AMRO at the time in the United Kingdom. In 2001, she became, in the context of the Turkish crisis of the time, the vice president of the Banking Regulatory and Supervisory Agency of Turkey, a position she held for 2 turbulent years, and then she came back to the IMF. She was mission chief for Ukraine during the great financial crisis. She, at the European department of the IMF, she was then in the Monetary and Capital Markets Department, where she led the financial sector assessment programs for the UK in 2011 and for Spain in 2012. If any of the audience thinks that financial sector assessment programs of the IMF are inconsequential, look at what Ceyla did in Spain in 2012. And in 2015, she joined the World Bank as vice president, actually, for EFI, Equitable Growth, Finance, and Institutions. So we have very parallel scenes from both our speakers today, and in 2020 came back to the International Monetary Fund as director of the Strategy, Policy, and Review Department. So that's enough from me for introduction. I hope our logistical issues work well. Can we test your sound, Pablo? Please unmute yourself.
Does it work?
Yeah, it seems it works functionally. So we'll cross fingers everything goes right. And I think you will speak for 10 minutes, and then we'll hear from Ceyla. Floor is yours, Pablo.
Thank you. I don't know if I should share my presentation or go directly.
Prefer. I can move your slides if you want me to do that, or you can move them yourself.
Let me see if I can do that. Apologies, I just connected. I had some issue with the connection. Maybe you could upload it from your side, Nicolas. Thank you. Excellent. So basically, the part of this presentation comes from a report that we are launching this week called Finance and Prosperity. It's the first on a series of reports that we'll issue over the next couple of years. And this report particularly focuses on 2 topics. One is the sovereign bank nexus, and we'll talk about that in this session. And the other topic is climate and the banking sector. Now, even before we get to the topic of sovereign bank nexus, we need to have a good sense of what's happening in the broader context of debt vulnerabilities, and that's where I start here. And I start with the countries that we see as the most vulnerable in this situation, which are basically low-income countries and a set of lower middle-income countries. In the World Bank, that group, we call it IDA countries, are the countries that have access to the IDA window of more concessional lending. And what we can see in these countries is that basically since 2023, we are at record high levels over the last 2 decades in terms of debt as percent of GDP. Of course, the averages hide a very significant increase in a number of countries that are way above 80% of GDP, even though that over the last 2 or 3 years, we have seen some consolidation taking place. And that's good that consolidation has taken place, but clearly not enough to arrest fully what's the growth that is taking place in terms of that. Now, the next slide shows that this comes into a broader context linked, of course, to this. One, that again, we are at record levels in terms of gross financing needs for IDA countries. The numbers, the averages that you see there, including the one for 2024, hides again countries that are at very, very high levels. We're talking countries that are about 24% of GDP in terms of gross annual financing needs, fiscal needs for 2024. So again, a very pressing situation for many countries. Some countries face issues, some countries facing significant liquidity issues. And the other part of that context is what you see in the right side of the screen there, which are the net inflows of external debt to countries. And here, what you see is that a trend that was happening in the decade prior to COVID, which is the private sector coming in big time with net positive external debt flows to IDA countries, it has actually gone the other direction now. And the numbers there stop at 2022, but we have some preliminary numbers for 2023, and the story is basically that for 2023 the numbers there get worse. Basically, you will see private credit in net terms basically at zero coming to countries, again in net terms, and same for bilateral creditors coming at zero, very close to zero for 2023 in terms of net flows of debt. And that's the context that countries are facing, and that's why there's such a discussion also in terms of liquidity pressures. The next slide goes deeper into one of these aspects, which is the debt repayments that countries are facing. Starting in 2022, debt repayments increased by 50% in IDA countries, and are at a very record high level now. Both domestic and external, which is the left side of the screen, are roughly at 7.5% of GDP. And that's, in terms of revenues for these countries, that's half of the revenues, basically. And if you look at those in terms of their expenditures, they are this debt service, these debt repayments are larger than the health, education. I would add even a bar there on the infrastructure side, and combined, and are larger than that. So it's a big pressure. It's a crowding out significantly development spending in countries. So it's a very serious issue. Next slide. So as we go into the sovereign bank nexus, this is another facet that we have been seeing in these countries, and is that the holdings of government securities as part of bank assets has been growing over the last 20 years. Now, this is normal and is good in terms of, when domestic markets start to develop, this happens. So there's nothing normal about a growth in holding of banks of sovereign debt. What is interesting, however, is when you break down countries by countries that are facing macroeconomic distress and countries that are not facing macroeconomic distress. And here the sample of countries is much larger. It's a sample of around 80 emerging and developing economies, more than 3,000 banks that we looked at. And what you see here is that the countries that are under more macroeconomic distress, and those are the solid lines, are actually have banks, both private and state-owned, that have larger holdings of domestic sovereign debt, of the sovereign debt. And again, the numbers here, the averages here, hide a number of outliers, very dangerous outliers that have 30, 40, 50, and a couple of countries even close to 60% of their total holdings, their total assets in government securities. And of course, there's a big overlap between being in macroeconomic distress and that makes it very, very dangerous. In the next slide, we did a simulation, basically looking at banks in countries that are under economic distress and see what would happen if it would have a hypothetical loss of government securities, like because of a debt restructuring, for example, of 5%. And basically what you get there is that 20% of the banks on those countries would be undercapitalized immediately if they have a 5% loss on that, and which could happen in a restructuring process. And if you increase that to 20% of losses, then you roughly go to half of the banks that would be undercapitalized. So it's a serious risk that is building up in this particular set of countries under distress for banks. And it's becoming a ticking bomb in some of them. In some of them, it's happening already, and interventions need to be made. But it's a risk that one has to look at. And again, there's nothing wrong with building sovereign debt as part of bank assets, but when it's combined with bad macroeconomic management, and let's look at the next slide, and with let's go to the next slide perhaps, and also with weak institutional capacity, that becomes a problem. And here in this slide, what you see is that it happens also that the countries that have higher level of sovereign bank nexus, they also have the weaker institutional frameworks in dealing with banks. They have weaker institutional frameworks in terms of capacity to deal with crisis. They have weaker or non-existent resolution tools to deal with banks, weaker frameworks for crisis management, for how to deal with liquidity provision. They have weaker or non-existent or non-appropriate safety nets, deposit insurance funds, and so on. So the red boxes are the ones that look at insufficiency, and of course there's an overlap between the countries that actually have built up significantly sovereign bank nexus and don't have the institutional capacity. Next slide. So how to deal with this situation? And we came here in this report and in part of this presentation through the angle of the build-up of this sovereign bank nexus, but this requires, of course, a much broader, more comprehensive approach. And together with our partners in the IMF, with Ceyla and her team, and our teams have been discussing a more comprehensive framework approach to deal with these situations across the countries that need it. And we have a structure of three-pillar structure, where we look at structural reforms and domestic revenue mobilization, and include issues of spending efficiency, the development of measures to enable private participation in the economy, and so on, as one block. A second block that deals with external financing to deal with this issue of net positive external debt flows that I was talking earlier, and a third block on actually take actions now to help reduce those very high debt servicing burdens that countries have, including through liability management operations. So I'm glossing very quickly through this because Ceyla, in her presentation, will go in depth into these aspects. And now one aspect that is part of that comprehensive view, but it's more in the context of this report, where there is also a an angle for the banks to do something. Again, doing something on banks on this particular issue is not going to solve the bigger issue. The bigger issue needs a number of bigger measures that are part of that framework that Ceyla will discuss. But there are still some measures that banks can take. And and we put forward some ideas. And none of it is straightforward, and there are always pros and cons, but we'll go through them. One is having a more granular disclosure requirements for banks, both public and private, on their exposures to the public sector, just to enhance market discipline. The second is a careful consideration of benefits and drawbacks, the pros and cons of capital charges. Again, this is in the context of emerging and developing economies, not advanced economies. But even in that context, there are pros and cons. But maybe there's ways in which, above certain thresholds, some incentives on the capital side could be implemented to discourage a non-prudent accumulation of those securities. Also, come back to the Basel agenda in terms of capital buffers, in terms of financial safety nets, in terms of institutional capacity and tools to deal with crisis. There was some progress after the last crisis in 2009, but we still have a large number of countries that haven't made significant progress on this front. So it's probably a good time to come back to that. And of course, one more broader, more structural aspect, which is the development of domestic capital markets and diversification of the institutional base. So banks are not crowded out by the sovereign securities, and that's not crowding out private credit, which is happening in countries that have very significant shares of sovereign debt as part of banks' assets. So let me stop there and give way to Ceyla, who will go more into the strategy that we are discussing and thinking. Thank you, Nicolas.
Fantastic. Thank you so much, Pablo. Ceyla.
Thank you, Nicolas, and great to be here with you and Pablo in this panel to discuss this important topic. First of all, congratulations to the World Bank team for launching the Finance and Prosperity Report. It's an excellent resource on financial sector issues in emerging market and developing economies. So kudos to the team. I think this is a very good contribution. The sovereign bank nexus is a risk in EMDs, but it's a risk globally, not just in EMDs, given the backdrop of rising fiscal vulnerabilities. We had many examples. You mentioned the euro area crisis, Nicolas, in 2010, 2012, last year's regional banking crisis in the US, when the large holdings of long-dated US government bonds led to significant bank losses and depositor outflows, as well as some bank failures. So I just wanted to mention this. It's a global phenomena, and hence the importance of FSAPs, the financial sector assessment programs. This is a joint initiative of the bank and the fund. It was put together after the Asian financial crisis, when we realized that banking sector issues or financial sector issues can create macroeconomic problems. And that's why it's very important that we put a lot of emphasis in integrating the results of the findings of the FSAPs into the IMF Article 4s in countries with or without IMF programs, to make sure that we monitor the developments and also advise countries on what they can do to improve the functioning of the financial sector. We also have a large program together with the World Bank in terms of technical assistance, capacity building in strengthening financial sector, strengthening crisis resolution. So I think that's a very important area of work, and more recently, really looking at how we can help countries develop institutional investor-based local capital markets, which are critical, as Pablo said, to reduce some of these risks. So I'm going to talk more today on the IMF World Bank proposal that we have put together. I have several messages. My first message is that we have to also acknowledge that the global economy and developing countries have been very resilient since the pandemic. I remember talking about what the scars could be from the pandemic, whether we would see a systemic debt crisis, whether we would have corporate bankruptcies and so on and so forth. And so far, it has been, not touch wood, a resilient. I mean, of course, there are lots of issues and we need to address them, but we didn't have the major systemic crises that we were all fearing. The G20 Common Framework for Debt Treatments has been put together precisely to help countries deal with unsustainable debt. We formed the Global Sovereign Debt Roundtable together with the World Bank. It's actually co-chaired by the World Bank President, the IMF Managing Director, and the G20 presidency. Now it's Brazil, to reach common understanding and resolve any impediments to rapid debt restructuring. It was slow, the common framework, but there's a lot of progress recently, and we can go into this in the Q&A as needed. We had a handful of cases: Chad, Zambia, Sri Lanka, Ghana, more recently in Ethiopia, but not the onslaught of many countries going into unsustainable debt problems. So my second point is that we now need to make sure that we have timely action on dealing with liquidity problems in many low-income and emerging market countries, because if this is not addressed, we will end up with a painful systemic crisis down the road. So an important metric is the share of the revenues that the government collects from population through taxes and other fees that goes to pay foreign creditors. It's generally 2.5 times higher than a decade earlier. Of course, there are differences across countries, so that has grown very sharply. And the typical low-income borrower, the share has risen to about 14% from about 6%, and as much as 25% from about 9% in some economies. So there is a huge debt servicing burden for many of the countries, and that, as Pablo mentioned in one of his charts, is squeezing the space for much needed growth enhancing investment and projects. So this is very important. So that's my last message, our joint IMF World Bank proposal. We have put together a proposal on a package of actions. None of this is really new. It's more putting things together in a more comprehensive package of actions to support vulnerable countries. There are 3 pillars. The first pillar is domestic resource mobilization. We have launched this initiative. It applies to all countries, whether they have liquidity problems or not. And we provide policy advice and capacity development on helping countries address tax loopholes, have better taxation, more progressive taxation, as well as increasing effectiveness of public spending, and develop domestic financial markets to channel savings to productive uses. So that's the DRM component, the first pillar. The second pillar is higher international financial support, and that's where we have the work on the 21st replenishment of World Bank's IDA, as Pablo mentioned, and in the case of the fund, the Poverty Reduction and Growth Trust, the PRGT, which provides zero interest lending to low-income countries. So that's what we are replenishing, both institutions, so that we can provide more financing to countries as they do the reforms, because as we have seen, unfortunately, more and more so, the political costs of reforms, adjustment policies require very good sequencing, transitioning, as well as supporting those that are most impacted by those reforms. So it's important to have the pillar 1, which is the reforms, but complemented with increased financing from international institutions as well as the official sector as much as possible to make sure they can manage the transition, which is very politically costly. And the last pillar, which is the most innovative part of all this, is ways of reducing debt servicing burdens. So this could include mechanisms by multilateral or bilateral partners to mobilize new financing, including using credit enhancement to refinance existing debt, also liability management operations, such as debt for development swaps, debt buybacks where appropriate, and so on. So we are working on all these pillars and hope to have more detailed proposal by the time of annual meetings, and try to address some of these problems, liquidity problems in specific countries, so that we can show these as pilot cases to other countries and hopefully make progress. Thank you again, and over to you.
Thank you so much. And of course, I'm always mindful of acronyms here, the IDA, IDA, which both of you refer to as the International Development Association, part of the World Bank Group. Pablo, first on the diagnosis, one thing that struck me as somebody who obsesses with banks is when you mentioned that in some countries, the banking sector had as high as 60% of their assets in government exposures. Well, I'm familiar with Lebanon, but can you tell us a bit more about, where we find this kind of extreme situations?
Yeah, I was afraid you will ask that. There are, there's a couple of countries, 3 countries that are between 50 and 60%. I prefer not to name countries now, but you will actually, I think you will find them in the report. I think we have a detailed chart on that. But there are some well-known large countries, large in terms of population, including that are above 50% of holdings of sovereign debt in banks. And again, it wouldn't be surprised that those are the ones that have been actually under severe macroeconomic distress. They have been in the press, etc. So, but I prefer not to name them if you don't mind.
I think you're referring to Nigeria, but you don't have to respond.
No, actually, no. Actually,
sorry, I got that. I'm intrigued. So let's go directly into the kind of nerdy details of regulatory responses. And we'll take also questions from the floor. We have an excellent audience on Zoom, so hopefully we'll have a number of questions from them. But before that, just let me ask one question about the regulatory stuff, because you referred to capital charges. And that's a debate I'm very familiar with in the context of monetary unions, and specifically the European Monetary Union. I've been among those who have advocated sovereign concentration charges, but that's also a very specific context where you can diversify sovereign debt within your monetary area. I mean, if you're a Eurozone bank, you can have debt from, Italy, Spain, Germany, France, what have you, without taking foreign exchange risk. If you're in a typical developing or emerging country, you cannot do that. And therefore, it's a very different set of challenges and trade-offs when thinking about capital charges. And I, for one, for example, would be hesitant to advocate them. So can you give us more of a sense of the trade-offs as you see them? I mean, in a way, the disclosure bit is the easy one. Everybody agrees that banks should disclose their exposure positions, and especially domestic sovereign exposures. But can you give us more of your thinking about the trade-offs and pros and cons of capital charges?
Yes. So on capital charges, I think there's a need for some sort of incentive not to overload particular banks, and again, once you enter a country that is very exposed to sovereign debt, there are banks that have much larger than the average of the country. If the country is at 40%, you will have banks that are at 80% or 70%, specific banks. So it has to be some incentive for them not to overload, and capital charges is potentially one idea. Above certain threshold, one can determine the thresholds are very country specific, and above certain threshold start to have capital charges. At the same time, so in a way to disincentivize an accumulation, which we all understand when you also pile up, and we have seen many developing countries pile up on sovereign debt, then that crowds out credit to the private sector that has also some growth effect, etc. So disincentivizing an overload, not disincentivizing completely, but levels that are too high is a pro. But on the con side, I think you could also see some countries, particularly those with much weaker regulations, much weaker capacity, having all sorts of bad incentives, including having even the government may provide them, if there's not a yield curve, there's no clarity in the market, they may provide them with instruments that have higher interest rates just to compensate for that. I mean, you could create all sorts of different bad incentives in countries that don't have the capacity. So that's why we are very careful in the report to say this is a debate. There are pros and cons, like the ones that I highlighted, and open the discussion on those or other incentives that may be particularly fitted for some countries. And again, none of them, particularly this one on capital charges, is not. You have to see a lot, and you know this, Nicolas, very well, the country context, the capacity, the laws on all the regulatory framework that the country has. Otherwise, you can create more problems than solve them.
Yeah, you've been very involved over the years with the Basel Committee discussion. Basel had a stream of work on this issue of sovereign exposures. I think it was back in 2016, 17, more or less. How do you see the trade-offs about, regulatory treatment, leaving aside again monetary union such as the euro?
I think it's Ceyla, right? For Ceyla.
Yeah.
Okay, so yes, I mean, as Pablo said, there are pros and cons. And what I have also seen is sometimes if you put in additional restrictions, the banks find very innovative ways of getting around them, right? Through some, I remember in my own country, in Turkey, there was a lot of derivative instruments with investment banks in London, so it wouldn't show up in the bank's balance sheets, but it was actually at the end the banks were responsible if there was any default by government. So I think one has to be very careful not to push banks to these type of innovative ways of trying to get around regulations, which unfortunately always ends up being the case. I think having, for the regulatory authority, having stress tests to make sure that the relevant bank, that each of the banks don't have excessive holdings of government debt, and that the maturity structure is such that they can withstand any deposit withdrawals or any kind of concerns. I think those are good measures to take. So using stress tests and asking for, this was one of the issues that Pablo raised, stronger capital buffers and so on. But at the end of the day, if it all depends on what type of macroeconomic management the country has. If they're going to run the country to a crisis, no matter what charges you have, what incentives you have, the banking sector will suffer large losses. So I think it's important to make sure that the macroeconomic situation and the policies are adequate, and then have a plan to increase institutional investors, longer-term holders of government paper, who can better address this risk and manage this risk compared to the banking system. Some countries have been very good in making progress in this area, right? They have had capital, a lot of capacity development from international institutions as well as their peers, and have really increased their disclosures, better standards in terms of stress testing, but also making sure that there's a larger variety of investors that are holding government paper.
We have a question from Ahmed Kadri Bahul on your assessment of Egyptian debt sustainability. So if you want to comment on that, you're absolutely welcome to do, but that's a digression from our topic. So you're also allowed not to answer that question. Leaving that aside for a moment, we also have a question from one of the participants about what you see as a kind of healthy threshold. That's probably for you, Pablo, at least first. So I think you implied quite clearly two things. One, there's nothing inherently bad in banks holding government exposures. Indeed, the regulations want them to hold high-quality liquid assets, so in a way that's encouraged. But also that, if you're above 50, it's probably not good. At least I inferred that from your presentation. So can you give us a little bit more of a granular sense of where you see the, concern thresholds levels?
Yeah, rather than let me first pick up on one item that Ceyla highlighted, which is the stress test, and that's also part of our recommendations, that to conduct much more regular stress tests to deal with these situations. But transparency will do a lot. The issue of disclosures may be straightforward for all of us, but you will be surprised that many countries don't have that, and they don't do that. So there are a few things on transparency, on constant monitoring through stress tests that will be helpful. Now, in terms of thresholds, this is where we get to a very dicey situation, because I don't think that there's a threshold that applies to all countries in the same way, as it shouldn't. Countries have very different levels of development of their financial sectors, different levels of capacity to deal with these situations, and so on. Now, looking at the averages, it's helpful. When you look at the averages of the countries that are these emerging and developing economies that are not in distress, the holdings are roughly around 15% of the total assets. 15%. When you look at the average of countries, even the ones that are under more distressed, they are closer to 22, 23, and even those averages, I think they are on the reasonable side. It is when you get to above 30% that you start to see specific countries that combine the situation of being, and of course it's totally endogenous, right? Being on macro distress and having this situation is not one leading the other. So it's hard for me to talk about any threshold. The averages are very telling, and I can tell you that looking at the more granular data, above 28-30% of assets, then you see only countries that are in trouble. But again, it's not necessarily because of the nexus, but it's because of the macro distress that these countries are in, and it's all endogenous in the situation.
Ceyla, any comment on thresholds and levels?
Yeah, I think I agree with Pablo. As the numbers go up, of course, the vulnerabilities potentially increase. But I've also seen countries where you start with 30% or even less public debt, and then because of the crisis, that goes up to 100%, right? Almost overnight. Because so what I have seen in the past is, again, goes to the importance of disclosures, because there is hidden debt in public banks, especially state banks' balance sheets in some of the emerging markets and developing economies. So I think it's very important to have good disclosures, but also I think it's very important to, because it's crowding out in some sense, right? The more you have government debt, the less you give to the corporate sector or households. And that's why I think it's also important to complement any regulatory measures, any supervision, regulation of the banking sector, with also better understanding of quality of public spending. So, how is the debt why is the government incurring this debt? What does it go to? Does it go to productive use? How does it complement private sector borrowing? I think those are also important elements to understand what the thresholds mean. You can have two countries with 50% of government debt in banks' balance sheets, but then exactly how that debt is used, how it's complemented, makes a big difference.
There's a question from the audience about the accounting for that. You already mentioned, risk transfer techniques, derivatives to hide positions and the like. But maybe for you, Ceyla, how how do you think of the accounting and measurement issue? The person who's asking the question refers to, market accounting. Is there a policy issue here, or is it at a more basic level of already, disclosing the basic stuff?
There was a lot of work on this during the GFC, global financial crisis, if you remember, and looking at the procyclicality of market-based accounting versus book account, and again, as with everything, there are pros and cons. But if you do have fair market value, that tends to really bias results during boom-bust periods. Whereas if you have book value, that also doesn't give you the full picture, especially in boom times. So what we have been advising is having both, actually, using both as a way to understand, because they give you different types of information. And that's, I'm not an accounting expert, but when we do surveillance, when we do our work, we try to look at both types of information because of their different information value.
Yeah, and of course, for regulatory capital, I think everybody agrees that there needs to be some filtering of the short-term fluctuations of the market, but that from a disclosure perspective, there's a lot to say in favor of marking to market, at least the exposures that may be sold. Sorry, I'm talking my own book here, but I'm so passionate about this issue that I cannot refrain myself. We also have a question about...
You should join the conversation since you're an expert on a lot of these issues.
Don't tempt me. We have a question about the ratios to consider. Maybe to you, Pablo. The person is asking whether you shouldn't look at exposures to capital as opposed to exposures to total assets. I guess the answer is both are interesting, but how do you think about, what ratios to look at as a kind of your own mental dashboard?
Very similar to what I answered earlier, and I think that yes, you can do measures to assets or measures to capital equity, but they will tend to be correlated. Like high levels will be tend to be correlated on both, right? So and again, I want to make very clear that there's no single threshold that could be applied to emerging and developing economies. It's simply not possible. As Ceyla said, you may have countries that are much more developed in their financial sectors, have better regulation, and can withstand a much higher level of without any issues of sovereign debt in the balance sheet. And there are all sorts of buffers that the countries and the banks have to deal with that. But again, if you look at the chart that I have there, you will see that above the averages are, for banks for countries that don't have macro stress are, 15, 17% layer, and then you go up to 25 for the countries that are under more distress. Of course, those averages then hide the outliers, and that's what I have the fuller set of data, and I can tell you that about 30% in those particular developing countries that are in the sample, then you see the outliers and the situation with macro distress, about 30%. But again, I don't think that's a good measure of security. It just brings the red flags, and then you have to analyze what's happening on the macro side, which is typically what's driving the situation. The government doesn't have financing from outside, so then they are milking the banks to get their financing domestically. So one has to go through that analysis. That's more sensible, I think, than just looking at a benchmark that will tell you what's happening.
You're doing a great job, at least with me, in terms of selling the report. So as soon as it's published, I really will look at all the country by country data. We have a question which I suspect is from Matthew Sal on the fact that the IMF World Bank local currency bond market diagnostic framework was launched in 2021. And he's asking what have been the lessons from that and what kind of specific actions do you have in mind in terms of local capital market development, relying less on banks, market discipline, on debt issuance? Maybe let's start with Ceyla, and we'll come back to you, Pablo, on that one.
Yeah, thanks, Matthew, for the question. Yes, this is a very critical issue, and we have, but it takes time. Like it's not possible to develop domestic capital markets overnight. So there are several areas. One is improving debt management authorities, so helping them to reach out to outreach internally and externally in terms of marketing their debt. So there's technical assistance in that area, and we realize that some debt management offices do this much better than others. Peer learning has been very effective. So the first pillar of this is developing the debt management offices in different countries. Second is reforms in terms of pension funds and how to develop better this important institutional asset group, as well as the insurance sector and so on. These are usually the larger holdings of government paper. That, of course, takes more time. It's linked to pension reform and so on. So the lessons, Matthew, are the lessons that we know for a long time now, that you need a very sequenced approach, and that it takes time. It usually takes 5 to 10 years for countries to be able to develop the strong institutional investor base.
Pablo, also on this one?
Yes, maybe not to repeat what Ceyla rightly said, but maybe to complement with some topics on the support on debt management to countries, helping the authorities to help develop the yield curve in the market for their instruments, for the market, dealing with primary dealers, establishing the market infrastructure. Many countries don't have the basics of that. We have an initiative called JCAP for the development of capital markets, looking at all aspects, including diversification of the issuers, diversification of the investors. It requires a lot of work. It's long term, and we have a joint program with the IMF. That we are actually, as part of this initiative, we're planning to ramp up that work on that very aspect.
Sorry. We have a question from Pierre Raffi on the advice to banks themselves and how should prudent banks fit in the environment you described in terms of the cost of refinancing, the cost of sovereign debt is higher than it has been in the past. So what advice do you give to banks, basically, if they should be cautious about not accumulating too many government exposures? What other pieces are on their initiative? Maybe Pablo.
I think, the advice, obviously, that or the recommendations are more of regulatory nature, the ones that we provide, as it is part of our work. And again, we're advocating for transparency, for disclosure, which actually banks should be very keen on supporting, particularly when they are pushed by local authorities to take more paper from the government. I think they will welcome more disclosure, hopefully, of that. The issue of a stronger regulation in terms of regularly taking a stress test and monitoring their situation. And also, again, coming back to, and again, this is a regulatory agenda, but coming back to all the Basel agenda that we had in terms of resolution tools, safety nets, which I wouldn't say has been abandoned, but it's not going with the same strength as it was just after the last crisis. People forgot that we had a banking crisis, and they don't realize that some of these issues on sovereign debt can actually go into they are going in some countries into the banking sector, and they can actually detonate something else there. And being protected for that, particularly, I mean, again, you've seen in the report that are particularly the cases, the countries that are most vulnerable to this situation are the ones that don't have have developed these resolution tools and capacity. So I think that's the advice that we are providing.
We have a country-specific question from Christopher Spink, but I think it's a good question. He's asking, in some sovereign restructurings recently, there have been some countries where Ghana, Sri Lanka have restructured domestic debt, others like Zambia have not. So the way he frames the question is, where do you think optimum policy should go now? I guess the answer is it depends, but how do you think about those trade-offs?
Should I start?
No, why not?
Okay, I just pasted an answer to one of the questions. We had a report on this at the beginning of 2022 on sovereign debt restructuring. And the blog was saying restructuring domestic debt is like surgery. You only do it if you must, and you avoid it if it might do more harm than good. So it is very much depends on the case. I think this is where stress tests and understanding the implications, financial stability implications of restructuring domestic debt comes in. If it ends up, basically it goes from one pocket to the other, right? You restructure domestic debt, but then you have to come back and capitalize the banking sector. So I think it's very much linked to who are the holders of domestic debt. How do you make sure that you can continue to attract investment as the country restructures its debt, and how do you avoid financial stability issues? But yes, it is an area where we need to do more work, because domestic debt, local currency debt holdings have been increasing for many countries, but it's very country specific in terms of determination of what makes sense at what time.
And the blog post, for those who want to look at it, is titled Sovereign Domestic Debt Restructuring Handled with Care by Peter Breuer, Anna Ilyina, and Hong Pham. So that's on the IMF website. Pablo, do you want to comment on that?
Yes, very similar to Ceyla. We have been seeing all these countries, and different measures have been taken in different places, and it depends on how much destabilizing for the financial sector would that be, And if you have to have very high recapitalization costs, which ultimately become fiscal costs, and if those are higher than what you can do by not touching that part and having a more longer term solution for it, then you have to do those trade-offs, and those trade-offs are need to be calculated and need to be done very, very carefully, and that's what it has been done in countries. You also need to look at the holders of those the potential groups affected in those restructurings of domestic debt, which are also very critical. So a lot of care on doing that. It's not a straightforward situation, especially if you want to cause the least damage to the countries.
Thinking of situations where, coming back to the banking sector, where banks have been made insolvent by a sovereign debt restructuring, if you have, maybe that's in your report. Do you have best practices in mind or lessons learned? I mean, being focused as I am on Europe, I'm thinking of Greece here, of course. And the way it affected Greek banks, the creation of the Hellenic Financial Stability Fund, also the read across to Cyprus, by the way. Are there kind of shining best practices that leap to mind, or things that you think people should really look at in terms of precedent cases, or would you say that every case has good lessons? Pablo?
I think Ceyla will know more cases than I do, but I think you take good lessons from each situation, and some of those lessons are reflected in the report, and we discussed earlier, which are things that it would have been great that this country has this instrument, this tool to resolve the situation. So then we had having the tools available to resolve banks or to deal with these situations, it's much makes things much easier than the more tougher measures that you have to take when they don't exist. So I think it's there are a lot of foundational items that you have to have, and the other perhaps issue is that you have to deal with much broader problems than the banking sector when you are dealing with these situations, as was discussed earlier. Typically, this issue, by looking at the graphs, you could see that this sovereign bank nexus is a symptom of something bigger happening somewhere else, and you really have to go back to where the origin of the illness is to deal with it. Yes, you can take some measures on the banking side, but that's not nearly enough for curing the cancer that is somewhere else. And I think that's a very important understanding of these issues.
Ceyla?
So I think there are lessons, of course, from each case, but I think the biggest lesson is to have a strong crisis resolution framework. Actually, the bank has a very good team. I hope they're still doing it. The fund also provides some technical advice on this, doing crisis simulations in countries and trying to address what are is there a mechanism to bring everyone together to make quick decisions when there's a problem in the banking sector, so it doesn't end up exacerbating the problem. So, and those tools will need to be adapted over time. The lessons we can take from 20 years ago, yes, some of them are of course relevant, but now when we have digital assets, crypto assets, you have social media, much more rapid transmission of news and so on, we are faced with a very different landscape. And I think that's why I keep mentioning these simulations to, in good times, to simulate what would happen and to make sure that the countries have the tools and instruments that they can deal with. The one that the tools that are very critical and take time to develop, one is bankruptcy mechanisms, especially for the corporate sector, because once you have problems in the sovereign, it quickly goes to the corporate sector and it becomes a vicious cycle. So if you can deal with corporate bankruptcies quicker, that helps to deal with the larger problems. And then the other one is liquidity. So whether it's a deposit insurance fund or some sort of a liquidity fund, to make sure that there are, with guardrails, there are mechanisms to support liquidity problems that doesn't end up with a solvency problem. I think those are the two big lessons that we have learned.
We're at the hour, but I cannot resist, since you mentioned crypto, to picking up the question from Guillermo Alborta. He's asking how has the official recognition of crypto as domestic asset, that's his words, impacted positively or negatively your evaluation of the financial sector? Maybe a one-line view on this, Ceyla and or Pablo?
Very difficult, because they're very volatile assets. So I think I would say it's made it more difficult as we learn. So as we get more knowledgeable on the topic, it will be easier. But right now it's very difficult.
Pablo?
Yeah, it was not part of this report, but of course in emerging and developing economies, particularly developing economies, AML issues, FATF issues are very, very critical when you talk about this. And actually that's an angle that has come out strongly in some countries that have decided to embed crypto much more mainstream in their countries. And again, you get bump into these issues of AML, FATF, and so on.
We looked at you, the world coolest dictator. Anyway, unfortunately, we have to stop here because we are at the end of the hour, but this was very rich discussion. The next session of the series will be on Monday, The 9th of September, we'll discuss a European issue about regulation of securitization with Emmanuel Véron from the Banque de France and Sebastian Mack from the Jacques Delors Center in Berlin. But before we close, I want to again very warmly thank our two speakers, Pablo Saavedra from the World Bank, Ceyla Pazarbasioglu from the IMF for illuminating comments on this very important topic. Thank you so much.
Thank you.
Thank you, Nicolas. Thank you, Ceyla. Thank you, everyone. Bye.